Fidelity is about to do something no traditional financial giant has ever dared to attempt with Solana. On November 19th, the Fidelity SOL Staking ETF is scheduled to go live, and if it does, it might change everything we thought we knew about crypto adoption, staking, and institutional power. This isn't just another ETF. This is a direct shot at the core of how value flows inside the Solana ecosystem, and it's sending shockwaves through both Wall Street and the crypto world. Because for the first time ever, a major institution isn't just offering exposure to Solana. They're offering staking rewards, on-chain yield, and real participation in Sol's network security, all packaged into a traditional investment vehicle that everyday investors can access without even touching a wallet. In the next few minutes, you're going to understand exactly what makes this ETF so explosive, why institutions are suddenly scrambling towards Solana, what the risks are, and how this single launch could either supercharge Sol's price or introduce a wave of new volatility we've never seen before. Let's break down the story of the week and possibly the story of the year. Why this ETF isn't just an ETF. When people hear staking ETF, many think it's just another crypto product. But this one is different. Fidelity isn't trying to give investors a simple price mirror. They're creating a fund that actively stakes SOL on-chain, meaning they'll be locking up massive amounts of Solana. They'll be earning staking yield. They'll be distributing that yield back to traditional investors, and they'll be securing the Solana network while doing it. This is unheard of. It's not passive exposure anymore, it's participation. Staking usually requires wallets, private keys, and on-chain validation. Fidelity is removing all that friction and turning it into a product your grandmother could buy through her retirement account. And here's what makes it even more wild. A staking ETF means institutional capital is literally becoming a Solana validator. This changes the entire game. Solana isn't just being invested in, it's being supported, strengthened, and integrated into the deepest layers of traditional finance. But if institutions are stepping this deep into the ecosystem, what exactly are they preparing for? And why Solana, not Ethereum? That's where the story gets even more interesting. Why Wall Street is obsessed with Solana right now. Solana has become the darling of institutional attention, and that wasn't always the case. A year ago, SOL was considered too risky, too fast, too young. But everything changed when the market realized Solana wasn't a meme chain or a short-term hype project. Instead, it became the fastest-growing ecosystem for DeFi, real-world assets, RWAs, high-frequency trading, stablecoins, payments, tokenized treasuries, and enterprise-level use cases. Now, legacy firms like PayPal, Visa, and Stripe are integrating with Solana's architecture because it's fast enough and cheap enough to handle real business at scale. But here's the real secret. Institutions want yield, not hype, not memes, not potential. Yield. And Solana staking yield is exactly that, a steady, predictable, on-chain reward that looks incredibly attractive to firms chasing new revenue streams in a tightening economy. A staking ETF becomes a yield machine they can legally access without touching crypto directly. That's why Fidelity, one of the world's most conservative financial giants, is making this move before anyone else. But if they're first, the real question becomes, who's next? The race behind the scenes. Quietly, behind closed doors, other asset managers have been studying the same thing. BlackRock, ARK Invest, VanEck, Franklin Templeton, Global X. Some are already preparing their own Solana proposals. Others are waiting to see how the Fidelity product performs. But the biggest competition brewing isn't between ETFs, it's between ecosystems. Because this staking ETF signals something very clear. Wall Street is looking for the next breakout network after Bitcoin and Ethereum, and Solana is winning that race. Why? Because Solana has what institutions want most. Speed, low fees, high throughput, scalability without roll-ups, real, growing adoption. Ethereum still dominates DeFi, but institutions see Solana as the internet speed blockchain, one that can handle global financial infrastructure at scale. Now imagine what happens when billions of dollars begin flowing into Sol, not just for price exposure, but for staking and network participation. This ETF isn't a reaction to demand, it's preparation for the future. But there's a darker side to all this. The risks nobody is talking about. A staking ETF comes with benefits, but also several hidden dangers. 1. Institutional control of staking power. If institutional ETFs grow too large, they could control a meaningful portion of Solana's validator set. This means influence over governance, influence over network decisions, consolidation of power. Crypto was designed to prevent that, but money always finds a way to gain leverage. 2. Liquidity lockup. Staking ETFs lock up SOL. Locked SOL reduces circulating supply. Reduced supply usually boosts price, but it also makes the market more unstable. One major unlock or redemption could trigger heavy selling pressure. 3. Regulatory shifts. The SEC hasn't fully decided how to treat staking rewards. Are they dividends, income, a security feature, something else? If regulation hits suddenly, ETFs could be forced to unwind their staking positions, and that could get messy fast. 4. Centralized delegation. Institutions might stake through only a handful of validators, compressing decentralization. All of this is real, all of it matters, and most people have no idea. But while the risks are serious, the short-term impact is undeniable. This ETF could spark one of the biggest Solana demand surges we've ever seen. Before we go deeper into the next part, the part where Fidelity's strategy becomes shockingly clear, let me say this. If you're following Solana, if you're watching the ETF race unfold, if you're interested in the events that will define the next crypto cycle, subscribe to Alts Club right now so you don't miss the updates that everyone else hears about too late. Now, let's get into the part that connects everything. This date is not random. Fidelity carefully aligns launches with market cycles, liquidity windows, and regulatory timing. A few things are happening around this period. 1. Market liquidity rises before year-end. Institutional portfolios get rebalanced. Funds look for yield before closing their books. Crypto often pumps during this window. 2. Solana's ecosystem metrics are surging. User growth is exploding. Transaction volume is rising. DeFi TVL is expanding. Stablecoin flows are accelerating. Launching in a moment of growth ensures attention and adoption. 3. ETF seasons matter. Bitcoin ETFs launched during a tight liquidity window and still triggered billions in inflows. Fidelity knows the appetite is there. Now, they're testing whether Solana can replicate even a fraction of that success. 4. Competitive timing. ARK and VanEck are preparing their next filings. Fidelity wants to be the first mover, the one that sets the tone for staking ETFs. This isn't a launch, it's a lineup, a strategic setup for what institutions believe Solana's next phase will look like. But what happens after the ETF goes live? That's where things get even more interesting. How the ETF could impact SOL's price. Let's talk effects, not hype, not speculation, but real mechanics. Short-term impact. Immediate increase in SOL demand. Possible reduction of circulating supply due to staking. Increased investor attention. A narrative pump similar to pre-Bitcoin hype. Even modest inflows can have a large impact on a blockchain with tight supply dynamics. Midterm impact. If yields are distributed effectively, the ETF becomes a magnet for conservative investors. Compared to volatile altcoin plays, this becomes the safe crypto yield product. Other issuers copy Fidelity. Solana staking demand skyrockets. Validators become more competitive. DeFi inflows accelerate. Solana becomes the yield chain of choice. Long-term impact. This is where things get complex. If enough SOL gets locked, the network becomes extremely secure, but also potentially exposed to institutional influence. However, Solana's design naturally decentralizes validator competition over time, meaning institutional power will likely get diluted as the ecosystem grows. Long-term, a staking ETF could push SOL toward the same league as ETH and BTC in terms of mainstream legitimacy, but nothing comes without a price. What Wall Street knows that retail doesn't. Fidelity's analysts are not YOLO traders. They don't launch products based on hype. They launch products based on data. Here's what they know. Solana is one of the strongest performing assets in the last 2 years. Its ecosystem growth is real and accelerating. It has real-world adoption, not just speculation. Institutions love predictable yields. Tokenized assets are coming, and Solana's speed is unmatched. Crypto regulation is nearing clarity. Staking is the next frontier of institutional adoption. Ethereum staking ETFs are being quietly studied, and Solana, unlike ETH, offers higher yield with simpler architecture. Fidelity sees what most retail investors overlook. Solana isn't just a blockchain, it's infrastructure for the future of capital markets. What this means for crypto as a whole. The approval and launch of a staking ETF does not just change Solana. It changes how traditional investors access yield, how institutions interact with blockchains, how staking is regulated, how validators compete, how DeFi integrates with Wall Street, how other chains position themselves. If this ETF succeeds, it becomes a blueprint. Ethereum staking ETFs would follow. Cosmos ETFs would follow. Avalanche, Aptos, Near, all would get institutional doors opened. We are watching the beginning of institutional staking, something that could reshape blockchain economics entirely. A new chapter begins on November 19th. The launch of Fidelity's Solana Staking ETF is more than a product release. It's a turning point, a signal, a moment when legacy finance and next-generation blockchain technology finally collide. With this single move, Solana steps into the spotlight as the network institutions trust to deliver real yield, real utility, and real scalability. Whether Solana's price explodes or the market reacts with caution, one thing is undeniable. The narrative has changed. Solana is no longer the outsider. It's becoming the backbone of the next wave of financial innovation. And November 19th is the flashpoint that starts it all. If you want to stay ahead of these moves, not behind them, subscribe to Alts Club. This next cycle will be defined by those who see the shifts early, and Solana's shift is happening right now.